Hello and welcome. This update provides a high-level overview of global market developments in November and outlines how these conditions are reflected within our model portfolio framework. This communication is for information purposes only and does not constitute financial advice. November was constructive for global equities overall, although the performance varied across regions and sectors. This type of environment reinforces the importance of diversification and disciplined portfolio construction within model portfolios. As per usual, we'll start with the United States. The US equity markets were mixed during the month. The S&P 500 rose 0.2, the Dow Jones gained 0.3, while the Nasdaq declined 1.5%, ending a 7-month upward trend. Markets recovered late in the month as expectations around the future path of interest rates stabilized. Although leadership remained narrow and valuations in parts of the market stayed elevated. Within our model portfolios, the US exposure continues to be maintained as part of a diversified global allocation, with an emphasis on broad market exposure and quality characteristics rather than concentrated positions. In Europe, equity performance was more muted. The French CAC 40 finished the month flat, while Germany's DAX declined 0.5%. Economic growth remained modest, supported mainly by exports, while domestic demand stayed weak. Model portfolio exposure to the region remained balanced, reflecting its diversification role rather than a reliance on near-term growth. UK markets were also broadly flat. Economic growth slowed further and inflation pressures eased only gradually. These conditions continue to support a cautious and diversified allocation within the model portfolios. Turning now to Asia, performance across this region was mixed. Chinese markets remained under pressure, with the Shanghai Composite down 1.7% and the Hang Seng lowered by 0.2%. Weak domestic demand and ongoing structural challenges continue to weigh on sentiment. Our model portfolio exposure to China remains measured, reflecting ongoing uncertainty. Japan was a relative outperformer during the month. The Nikkei index rose 4.1%, supported by foreign inflows, improving corporate governance and stable earnings expectations. Model portfolios remain exposed to Japan as part of a diversified regional allocation. So closer to home, South African markets delivered another positive month. The FTSE JSE All-Share Index rose 1.6%, marking a 9th consecutive monthly gain. Performance was driven by strength in resource stocks, supported by higher commodity prices and by property shares, which benefited from expectations of a lower interest rate environment. Financials posted modest gains, while industrials shares lagged, largely due to weakness in the global tech-linked names. A stronger rand, an improvement in South Africa's sovereign credit rating, and a 25 basis point reduction in the repo rate contributed to improved market sentiment. Within the model portfolios, South African assets continue to play an important role in diversification, income generation, and long-term return potential. From a portfolio construction perspective, 3 principles remain central. First, portfolios are positioned for gradual changes in interest rates rather than rapid policy shifts. Second, diversification across regions, asset classes, and sectors remains a core risk mitigation tool. Third, an emphasis on quality and liquidity is maintained to support portfolio resilience across different market conditions. In summary, while markets delivered positive returns in November, uncertainty remains. Our model portfolios are structured to balance participation in market opportunities with appropriate risk management, aligned with long-term investment objectives. Thank you for your time. We will continue to monitor market developments and review portfolio positioning as conditions evolve. Thank you. Enjoy. If you are traveling, please travel safely during the festive period, and we look forward to engaging with you further in the new year. All the best. Goodbye.